Great. So just to walk through the agenda, again, we have some welcome and introductions, as well as some working group updates that I'll go through in just a second. Again, please update your Zoom square with your name, state, and organization to introduce yourself. Next, we'll have a presentation on the clean energy tax incentives in the Inflation Reduction Act from Grace Henley, Tax Law and Policy Fellow with the Tax Law Center at the New York University Law School. Then we'll just have a discussion. I know typically we go into breakout groups, but we thought since these are such an interesting area for discussion, we'd like to keep this as a full group. But of course, always happy to entertain breakout discussions if folks would like. And then we'll wrap up from there. So just a couple of updates on the working group side. As you all know, in addition to these monthly meetings where we try to share information that might be relevant to your work, advancing clean energy-based economic development, NASEO and IEDC are also offering a couple of deep dive options. Deep dive option number 1 is in-state stakeholder meetings, where NASEO and IEDC would work with you to host an in-person roundtable meeting, really to bring key stakeholders around the table for discussions on what the next chapter might look like for your state in terms of clean energy and climate funding, planning and implementation, and how that can help support economic development and clean energy goals in your state. So we see this as potentially most appropriate for any working group members, both state energy offices or economic development partners that might be in need of sort of broad alignment with key stakeholders, really elevating some of the economic development opportunities associated with clean energy and climate funding and incentives. And hopefully, the first step in getting key stakeholders and decision makers on the same page as you all are. And so I won't go into this slide into too much detail, but essentially NASEO and IEDC can assist you by brainstorming agenda items, helping recruit speakers, really making sure that the event and the conversation is as valuable as it can be for your goals and needs. Deep dive option number 2 is facilitated action planning. And this would essentially be a series of virtual discussions that NASEO and IEDC would help host. Again, we hope it would be focused on sort of the state energy office, the state economic development agency or key organizations, and then also focus potentially on specific federal funding and incentive opportunities. So NASEO and IEDC could take, could help with researching opportunities, tying it to your goals, helping with grant writing, making sure that both the clean energy and the economic development perspectives are integrated into the application process. We're hoping, we've already been in touch with a couple of states. We're really excited about that, but feel free to reach out to Grace Lowe, glo@naseo.org, or me, Sandy Fazeli at naseo.org, to sketch out a game plan and set up a scoping call and everything. So just checking the chat. Great. Thanks so much for introducing yourselves in the chat as well. All right. So with no further ado, I'd like to go ahead and introduce Grace Henley. Again, she's a tax law and policy fellow at the NYU Law School. I won't go into too much detail on her bio, but please rest assured that she's got great expertise on tax law issues. She and her team have been working really hard to help educate states and other key stakeholders on the IRA tax incentives. So she's put together a presentation for us to learn a little bit more and help inspire some discussions and maybe some action planning when we go back to our day-to-days. Grace, I'll turn it over to you and let you get started.
Wonderful. Well, first, thank you all so much for having me. Like Sandy said, I'm Grace Henley. I'm a law and policy fellow at the Tax Law Center at NYU Law. If you haven't heard of us, we're a nonprofit. We sit under the NYU Law umbrella, and we seek to protect and strengthen this tax system through rigorous legal work and advocacy in the public interest. And I have been lucky to work very closely over the last year with our climate tax project, which is specifically focused on the clean energy credits in the Inflation Reduction Act and their implementation. And so I am going to take you, I'm about to launch a PowerPoint here, and I'm going to take you on a whirlwind tour of the clean energy tax credits, the bonuses, and the interesting changes worked by the IRA as far as how these credits are monetized. But because we aren't an enormous group here, I guess I'll just ask before we get started whether there are specific learning goals from anybody in this room, if there are particular areas of the IRA, certain types of credits, or other things that you really want to make sure you get out of this hour. I would just love to hear about that at the outset, so that I can make sure that we give those things as much time as possible. So I'm gonna allow you to either speak up. Yeah, Anya, am I pronouncing your name right?
You are, yes, thank you.
Wonderful. What can we do today?
I'm Anya Richmond. I'm with the Wyoming Energy Authority. And one of the things that we're just starting to kind of wrap our heads around is, I guess, public-private partnerships in light of the tax credits. So like we have grant programs that can support clean energy projects. So is there a way then that we can be doing that? So the state is also benefiting from those tax credits.
Okay, great. I'm gonna try to touch on some things that I think at least are at least adjacent to that question. And throughout the different segments of this presentation, I'm gonna pause and ask you to sort of chime in with questions. There's so much to cover here that I don't want to wait until the end to hold questions. So Anya, you'll just tell me if we get on a topical area that fits into this bucket. We can spend a little bit more time there. Anybody else, if there's any particular learning goals you want to hear about? I don't promise to be an expert in everything that you're curious about. In fact, I promise to not be an expert in everything that you're curious about. But again, would just love to make sure that this hour is really useful for you.
Hi there. I'm Kayla Lucero Matusi from the New Mexico Economic Development Department. And if you have any input on the public education component of this, I would be really grateful.
Can you tell me more about what you mean by public education?
Yeah, making people aware of these opportunities and how we ensure that that's not just, for example, companies with the greatest capacity to leverage that. But, I also sit in our Office of Justice, Equity, Diversity, and Inclusion. So I think for me, I've been wondering how we can make sure that these benefits filter down to the right people as well.
Thank you so much for that question and for the explanation. That was so helpful. And yes, this is something that I'm thinking about a lot also. We've labeled this kind of like taxpayer services, but there's definitely an environmental justice and an equity focus to a lot of the changes that the IRA is trying to work in clean energy. And we're going to talk today about how that information is reaching folks, the new groups that are eligible for some of these clean energy credits who haven't been eligible in the past, et cetera, and how that can match up with the environmental justice focus of the IRA. So yes, I promise that we will talk about that. Last call, anybody else with a particular issue area that they'd like to flag? Type of clean energy project you're interested in hearing about, businesses in the communities where you work that you want to make sure you sort of cover their questions. Anything else that we can be aware of before we get started?
Grace, thank you for the opportunity. We recently had RMI hosted a boot camp with the state of Wisconsin. So I don't know if that's an affiliated organization. There were several states that were part of that 2-day boot camp on IRA. And some questions arose just regard to timing and, how do we market it? When will credits be available? So perhaps you will cover all of that. And then secondly, there was some kind of dual interpretation of the law that reflected nuclear power plants that are going through the process of decommissioning, and could they be eligible for IRA credits if by chance they wanted to put, solar panels on a decommissioned nuclear power site. So don't know if you have had that question before.
I have. There has been interesting discussion around how IRA plays into avoiding retirement. There's actually a credit 45U that's specifically focused on sort of enabling or supporting nuclear power and staying online. And then there is some interesting discussion in the hydrogen tax credit space about how nuclear may or may not be able to plug the energy that they produce into hydrogen production. But I haven't actually heard the could you put a different type of clean energy project onto a nuclear site question before. So I don't know that I'll have anything to add, but like we're always really, really glad to hear about new issues that potential projects are chewing on. So like, thank you for that one. And yes, I will touch on timing. I have some of that built into the presentation already, and I will do my best to cover it. But again, I'm going to be stopping at intermediate points throughout the presentation. And so if you have a specific timing question that I haven't answered, please flag it for me, shout at me. And if I don't know the answer, I can at least try to point you in the right direction.
Thank you.
Which is going to be true like across the board here. Okay, well, I guess this is a good spot for me to gonna share my screen. All right. I'm hoping you all are seeing a slideshow now. Can somebody give me a thumbs up? Yes? No?
Looks great. Yep.
Cool. Wonderful. Okay, so I should start with this disclaimer. I am a lawyer. I am not your lawyer. In fact, I'm not anybody's lawyer because we are a policy and public interest shop and we don't provide representation to clients. And so please do not construe any of what I'm going to share with you as legal advice. It is group education, if anything. I'm going to do my best to speak articulately to this interesting intersection between like clean energy and science and tax. And I'm going to stumble over some of all of that terminology. We're going to move slowly together. But first and foremost, I am not your lawyer in this room, but hopefully we'll be a resource for each other today. All right, so we've got a lot of ground to cover. This is my agenda in general. I just want to sort of talk a little bit about the context of the Inflation Reduction Act, and then we're going to talk about the two biggest pools of tax credits, the investment tax credit and the production tax credit. Then we're going to talk a little bit about elective pay, often also referred to as direct pay, and transferability. These are the unique new monetization provisions included in the IRA that allow clean energy credits to be claimed and used by a larger group of projects. Then we're going to talk a little bit about the specific sort of base credits, the types of technologies that are sort of covered by the credit regime, and then we'll talk about the bonus credits. I'm gonna really try to save time for that because I know that many folks may actually have some questions about some of these bonus credits. And actually, Sandy, if I'm like running behind, feel free to shout at me, okay, to make sure that we get to this.
Will do. Thanks, Grace.
It's an ambitious agenda. All right, so some goals of the IRA, first and foremost. Many of you, I'm betting all of you already know this. I'm not telling you anything that you don't know, but there's these sort of big four priorities to reduce emissions, to support a just transition, including making sure that environmental justice communities and frontline communities are not left behind as we transition into a clean energy economy, to support good, high-paying, high-quality jobs in the clean energy sector, and to promote domestic production, and to build a domestic supply chain for clean energy materials to improve energy security and to strengthen U.S. manufacturing. So these sort of four goals underpin a lot of the nitty-gritty discussion that we'll have today. And then I just want to sort of let you see the categories of incentives that are covered by the IRA. There's like so many different things here, but as we mentioned before, generation and storage, the investment tax credit and the production tax credit, they do make up sort of the biggest piece of this pie. And then I'll just add a few words about the numbers that you're seeing here. You may have seen many different numbers in the news, or numbers different from these ones in the past. The numbers that I have here were drawn by a joint committee for taxation estimate from a recent House bill seeking to roll back the IRA. So they like scored the IRA at that time, and that's where these numbers are pulled from. But the truth is that these are, by and large, so credits where there isn't a limit to how many can be claimed. It's just based on the number of eligible projects who seek to claim them. So really, any scoring is an estimate. It's gonna ultimately be based on how active clean energy producers are and how fast this market accelerates. Okay, and then just a little context. You likely already know, probably many of you know way more about this than me, but Congress has leveraged the tax code to promote clean energy energy policy for many decades. Clean energy tax credits go back to the 1970s. The ITC and the PTC existed before the IRA, but of course, a lot of these credits looked different. They were often enacted for a few years at a time, and then they could expire or be renewed. And a downside is really that because there wasn't long-term policy, it was difficult for the clean energy industry to have the certainty it needed to invest and to grow the sector. And so we've seen many change, the ITC and the PTC existed before the IRA, but we've seen a lot of changes worked to those credits and other credits as a result of sort of the infusion of resources from the IRA and the policy changes that it's going to work. And then it's also true that both the ITC and the PTC were text specific prior to the IRA. And will continue to be text specific for a little while, which means text specific in this context means that there are credits named for particular categories of renewable energy, like wind or solar or geothermal. And text specific is in contrast to the idea of tech neutral. And tech neutral is this concept that instead of being based on the type of renewable energy, for projects placed in service beginning in 2025, eligibility for the ITC and the PTC is going to be based on whether Treasury determines that a type of facility is a zero emissions facility. And so it'll stop being, are you this type of technology or not? And it'll begin to be, are you, a zero emissions technology that's part of a clean energy transition or not? And that concept is helpful in a lot of ways because it allows for innovation and new methodologies and some flexibility so that as technology develops, the credits can evolve along with that technology. But of course, it also means that we have to make important decisions about how we're calculating emissions and what types of technology we're considering to be a zero emissions technology. We'll talk a little bit more about that later. Okay, I'm going to pause right here because the next thing we're going to do is talk about monetization to just see whether there are any questions about what I've already said or burning commentary to add. Okay, hearing none, I'm going to keep going, but we're just going to continue to enjoy the like medium long pause together to encourage other folks other than me to do some talking. All right, so let's talk about monetization. A lot of the time we actually start by walking people through the tech specific credits and the bonuses, and we do monetization last. But I actually want to talk about monetization first here because I want to share with you how credits used to be monetized and then some of the changes worked by the IRA in monetization, because I think that it will get your wheels turning around the types of organizations and entities in the communities where you do work who may now be eligible or may be able to monetize these credits and be interested in engaging with them. And I'm hoping that will actually spark questions and discussion and give you a useful foundation when we dig into the technologies and the bonus credits themselves. So we'll start here. So there are two main ways that energy credits have been monetized in the past. The value of the depreciation of the ability to depreciate the energy property, and then the value of the credit itself. But the credit itself could really only be used by an entity that had tax liability because business credits were non-refundable. And so if a company did not have enough income or enough profit to have a tax bill, then they couldn't actually use the credit even had they earned it. And the IRA alters the monetization landscape through Section 6417, which enables applicable entities, which are basically tax-exempt entities, to receive elective pay. Elective pay basically makes these credits refundable. And then Section 6418, which allows non-applicable entities, so for-profit businesses, to monetize the credits even if they don't have tax liability through transferability by being able to sell them to somebody who does have a tax bill that they would benefit from the tax credits for. And so we're going to talk in a little bit more depth about what those changes mean and what we know about them so far. And I will start here by flagging that Treasury, the IRS and Treasury released proposed regulations for elective pay and transferability in June of 2023, but has not yet produced final regulations. So I'm going to tell you some things that we know from the statute, and then some things that we know could potentially be the regulations sort of underpinning these credits. But I will also encourage you to keep an eye on what those final regulations end up looking like. And we'll flag some areas of interest where there could be significant changes based on whether what's in the proposed regulations ends up in the final regulations, et cetera. Okay, so we're not going to spend very much time here on these fun diagrams. This type of diagram is like a very tax tool. Law school flashbacks for me. But we'll spend just a second here talking about how clean energy projects monetized credits prior to the IRA. And this is like a very common way that a clean energy developer that didn't have tax liability would monetize those credits before the transferability and elective pay innovations worked by the IRA. So this is called a tax equity partnership, and what we're seeing here is a partnership flip. And a partnership flip, basically, the developer of the clean energy project and a tax equity investor form a partnership. And in the beginning, for a set amount of time, 99% of the benefits of the tax attributes and the benefits would flow to the investor. And then, at the point that the investor has reaped the expected or agreed upon yields, which is generally going to be like when all the benefits are utilized, then we see the flip, which looks like this, where once the investor reaches their yield, the benefits of the partnership are flipped back to the sponsor. And the tax equity investor will retain a minimal, like a 5% interest, and there's usually the option for the sponsor to buy out the investor's 5%. And what we see with the tax equity sponsorship, with the tax equity partnership and the partnership flip structure is, of course, good work is happening here in monetizing a clean energy project. But first, there's some inefficiency. There's that 1% tax attribute dead weight sort of lost to the investor. But also setting up this big, complicated structure has a lot of costs. It has due diligence costs, tax advice is needed on both sides. You have to create this additional legal structure, et cetera. And so there really are only a few tax equity investors, and it's predominantly banks. And they really tend to, there's quite a bit of developer competition for that money. And the investors are in general going to lean towards well-resourced larger projects. And so this structure, it does monetize the value of the credit, but it disadvantages smaller projects, and it can make it difficult for there to be innovation in the market. And so there's lots of reasons that this has not been a sufficient solution. And so this brings us to some of the changes that are coming through the IRA. So first we have elective pay. Have folks heard, have any people familiar with elective pay? How much familiarity do we have? Yes, like thumbs, shrugs. Cool. So I'll just give you the basics. Yeah, was there a hand? Oh, thumbs up. Thank you. Appreciate you. So the basics here are elective pay can be claimed by applicable entities, which are tax exempt entities. They can be states, local governments, territorial governments, nonprofits, rural electric cooperatives, Native tribes, Alaskan Native corporations, et cetera. These are all groups that have historically not had tax liability, not filed taxes. Well, a nonprofit would file a 990, et cetera, but wouldn't have a tax bill, right? These are all exempt entities. And so because they're exempt and don't have historically a tax bill, they haven't been able to claim credits in the past. And then there's also just a few flagging this bottom line. There's a few clean energy credits, 45E, which is clean hydrogen, 45Q, which is carbon capture, and 45X that are going to allow even for-profit sort of businesses to claim elective pay for a certain, or not like it's, we often call it partial elective pay, but to claim a refundable credit just for those specific technologies. But in general, what we're talking about with elective pay is we're talking about tax-exempt organizations who can now claim a credit, and the credit is going to be refundable to them. Okay, and so here's an example. You've got a rural electric cooperative that invests 10 million in a solar array, and they meet the wage, labor, and domestic content requirements, and they claim an investment tax credit. Don't worry, we're going to talk about those bonus requirements later. They've never been subject to tax, and they've never filed a tax return. They go through the pre-filing registration process. They claim the credit. They place the solar array into service. They claim the credit. They get this $4 million ITC. Treasury sends them a check. And so that's what that would look like. There's a few special considerations for elective pay that I'll just flag here. The first is you have to register in the pre-filing portal. I've put the link there just in case folks are interested in going and checking it out. There's many resources on that website, including how to register. Folks who want to transfer their credits will have to register also, but the process might be a little bit more familiar to them because at least they are familiar with filing tax returns, whereas many folks who are going to claim elective pay, for example, state and local governments, will have never filed a return before. So they're going to need to know to go into the pre-filing portal, fill in information, get their registration number, and then they're going to need to remember to submit, to put that registration number on their tax return and to file a return, which for many folks will be new. And there's been, I'm wondering if this was one of the questions about timing. There have been some questions or some issues that folks claiming elective pay have had around the tax year issue for the very first year. Barb, you'll tell me whether this is one of the questions that you were having, but for folks who haven't filed returns in the past, the credits are available for projects placed in service after December 2022. So like any project that is placed in service from January 2023 on, but it's for that tax year. And so the trickiness here is that if an organization already had an established tax year and their tax year was, let's say, the state fiscal year, July 1st through January 30th, then even if they placed a project in service in January of 2023, that would be part of a tax year that started in 2022. And that currently there's some ambiguity that like either if they already have that tax year, they really probably are in trouble. But the most ambiguous place is for applicable entities who do not yet have a tax year, who have not filed yet, and subsequently like they haven't established a tax year yet because they've never filed taxes, but they have a fiscal year. And again, if their fiscal year is not the calendar year, but instead it's the state fiscal year or it's the federal fiscal year, they could run into some timing problems around claiming a credit that is for 2023, but that falls during a fiscal year that started in 22. And especially if if by default that's going to be their tax year, or if they really want their tax year and their fiscal year to be on the same calendar, there's a lot of questions happening right now about that. What I can tell you is it's a known issue. There are great nonprofit organizations, Lawyer for Good Government in particular, that have been advocating on behalf of especially states and municipal governments who are encountering questions about how to handle this. And there isn't guidance yet, but I would, if this is an issue that you or members of your community are concerned about, if this timing issue is a timing issue that's on your radar, I would keep track of Lawyers for Good Government. They have a great FAQ page for elective pay on their website. And I think that they will be letting people know as soon as there is clarity about how to handle that type of timing issue. Yes, Barb, did you have a? Mhm.
Yeah, no, I was just going to say thank you, Grace. That was it. It was really the timing issue depending upon their tax year, or if they hadn't filed the tax year before. So incredibly helpful. Thank you.
Yeah, and I wish like there's a few possible solutions out there, either the option of making it clear to folks that they can choose a tax year different from their fiscal year. But of course, many orgs do not want a tax year that's different from their fiscal year. I think for state and municipal governments, you know, I'm not certain yet how tricky that would or wouldn't be for them to navigate, but I recognize that many folks are expressing that they would really like to be on a system where even if they can choose their own tax year, they want it to line up with their fiscal year. And then there's been an idea floated of like whether folks would be able to perhaps file a short year as a solution. So what I know is that people are talking about solutions, and I would keep tabs on Lawyers for Good Government. I think that they will be very quickly sharing information as soon as there's clarity. We wish that there was clarity now, but good folks are working on it. And I'm glad I'm glad I knew that that's what you wanted to hear about. That's great. Okay, and then there's another trickiness here for elective pay that Anya, I think, might hit on what you were interested in, which is there is an issue around partnerships in that the proposed regulations take the position that partnerships are not applicable entities, and therefore that elective pay is not permitted for them. And that means like a nonprofit and a government partnering together on a clean energy project wouldn't be eligible for elective pay, or a nonprofit and a for-profit. That doesn't mean that a project couldn't receive grant funding. Like receiving grant funding from a state, for example, wouldn't on its own, I think, make you into a partnership. But if you wanted to have like an actual partnership on a project, absent just like a project receiving, state or municipal grant funding in addition to claiming a tax credit, the proposed regulations do actually create some challenges there. There is this alternative that's proposed that I'm not going to pretend to be able to step you through right now, but there is a proposal in those proposed regs that that folks, although they couldn't form a traditional partnership, they could elect out of subchapter K, which is the set of tax rules that govern partnerships, and have an undivided interest in an ownership arrangement that's treated as a tenancy in common, or that is pursuant to a joint operating agreement. And if they set up a tenancy in common or a joint operating agreement, that potentially would be allowed. But there are some strings attached to those structures. And some folks have raised questions about whether partnerships overall should be disallowed, and or whether maybe partnerships of exempt entities should be allowed. And so what I would really encourage you to do, if this is one of the areas where you're interested, is again, keep an eye out for the final regulations, because the final regulations are where this decision will ultimately take place. And again, for these types of issues and the kinds of issues that impact states and local governments, Lawyers for Good Government's elective pay resources are a really great place to stay up to date. And then one other timing issue that I just want to flag, another thing that the proposed regulations included is they flag that you can't change an election via an amended return. And so that means that like you can file for an extension, and then you could even within, before your extension expires, you could file your taxes and claim your credit, and then realize that you made a mistake and file a superseding return. And that is under the proposed regulations going to be okay, but they do close off something called 9100 relief. So they say that if you file your taxes and claim a credit, or fail to claim for a property, or do something that you want to correct, you can correct it via a superseding return, but not via an amended return. Again, probably not enough time to step through all of that, but I think what I would say is what you need to know is anybody who talks to you, but especially exempt entities who are claiming elective pay and have not filed taxes before, they should file an extension. They should file an extension no matter what. If they plan to submit their 990 on time and they're telling you, I don't need to file an extension, I'm just going to do it at the deadline, they should file an extension anyway. And it does look, based on the proposed regulations, like folks who have never filed before will get an automatic paperless extension. But again, nonprofits who are used to filing a 990, but they haven't, who are used to filing a 990, but they like maybe haven't, had to claim credits before, haven't had the opportunity to claim credits before, et cetera, like they should be filing an extension, whether or not they think they need it, just in case they need to go back and correct anything. So I think that that's an important timing consideration for folks to know. Okay, I want to pause here for just a couple of minutes and ask if you have questions about elective pay.
So Grace, we don't have questions in the chat specifically about elective pay, but we do have a couple of questions that came in from someone who needed to jump off early. Is it worth visiting those now, or should we wait until the end of the presentation?
You know what? If it's not elective pay specific, will you flag it again for me at the end of the presentation, just so I can make sure that I am proceeding expediently? I'm going to run out of time. I always do.
There's so much, but thank you so much for being here.
Okay, great. Then if you think of questions about elective pay later, totally fine. Let's keep going. So next, we're going to talk about transferability. This is section 6418 of the IRA. And transferability is another way that Congress thought to monetize clean energy credits. And this is where a non-applicable entity, so a for-profit entity, can elect to sell their tax credit to someone else who has tax liability and can use it. And so the project that is eligible for the credit will be able to sell it, and they get the cash. The entity that buys it gets to claim the credit. Theoretically, they don't sell it, for the full value. Like if you have a credit for $100, you're not going to be able to sell it for $100, but maybe you can sell it for $90 or $95. So there's like a tight spread would be the word there. And that means that like the person purchasing it gets but the organization purchasing it gets a little bit of a discount, of an advantage that incentivizes them to want to engage in that process. But the clean energy project is still able to receive a significant amount of the value of that credit to support the clean energy project that they're developing. So this is an example, just a little bit more complicated looking than our applicable or our elective pay example. So a developer generates a $50 million investment tax credit. The developer doesn't have taxable income, so they sell the credit to another taxpayer. Here, I think it's Amazon for $45 million. So there's that discount, but they're still getting quite a bit of funds that they wouldn't have access to otherwise. The taxpayer claims their credit on the return and reduces their taxes owed by $50 million, and the taxpayer receives the benefits of that infusion of cash. And it is worth thinking about some special considerations for transferability. In particular, as more entities get into this space, there's going to be intermediaries popping up to aggregate credits, to find investors, to do due diligence for a cut of the value of the credits. And we're already seeing clean energy tax credit sort of insurers stepping in because purchasers of these credits are assuming the risk of audit or of clawback. And so these types of things will ultimately reduce friction around risks and due diligence, but they will also cut into the discount costs. And it can be tricky at the beginning of the development of a market like the transferability marketplace to figure out who truly has expertise and like who to trust. And so we should just keep tabs on that. And then, of course, there's questions around tax capacity. And tax capacity is like really the ability for the marketplace to to have enough folks who have tax liability, i.e. the capacity to soak up these credits and who will, generate demand for the transfer of these credits. And so one interesting spot to pay attention to is chaining. Chaining is the idea that applicable entities could purchase credits from for-profit clean energy projects and then claim direct pay on them. That would certainly increase tax capacity, right? It would create more buyers of these credits, but it's not currently allowed under the proposed regulations. And so, there's interesting discussion about whether it should be allowed or not, and it's something to look out for in the final regs. And then the other is something called passive activity limitations. Passive activity limitations require individuals or closely held corporations to have passive income, i.e. investment income, in order to use credits that are purchased through the transferability marketplace. And the truth is that many of those entities don't have investment income, and so they wouldn't be able to purchase credits at all. And that does cut a chunk of potential buyers out of the marketplace. So on the one hand, it could reduce the demand for credits. But on the other hand, if you let individuals, for example, buy credits, there's questions about whether they have the same ability to do due diligence, for example, on those credits, or whether that could create fraud or the perception of fraud in the marketplace, or the potential for people to not sort of have the same protections as a corporation buying a credit. So these are some of the balancing acts and the factors that are being considered. And ultimately, when we see final regulations, we will know how those turn out. And then this is just an interesting visual sort of representing what we talked about, potential expansion options versus what's in the proposed regulations here. Okay. Any questions right off the bat about transferability?
Grace, this is a little bit of a basic question, but in the Amazon sort of infographic example, just want to be perfectly clear that it's not the electricity necessarily that's being sold to Amazon. It's the tax.
Yeah, it's just the credit. It's just the credit. The electricity may have nothing to do with Amazon whatsoever. It is just that the clean energy project that is going to ultimately produce electricity is eligible for a tax credit, but if they don't have tax capacity to monetize that credit, they could sell it to Amazon and get their money that way. Great question, though. Appreciate the clarification. Okay, I am very bad at checking the chat at the same time.
I'm monitoring it. You're all good. Don't worry.
Wonderful. So glad to hear that. Okay, we're going to keep plugging. So next, I just want to talk very quickly about the investment tax credit and the production tax credit. So the ITC for generation and storage is Section 48 of the code. It provides 30% of the basis in an energy property. Here you can think of basis. Basis is a tax term. I apologize. But in this situation, you can think of it as sort of the same as fair market value. So 30% of the basis, which here is fair market value of the energy property for generation and storage. And that's if wage and apprenticeship requirements are met. And you get 6% if wage and apprenticeship requirements are not met. Before 2025, the investment tax credit for generation and storage covered solar and wind, and storage or will cover solar, wind, storage, microgrid, although microgrid is a little bit less common. And then starting in 2025, we transition to the tech neutral regime. And it's just worth knowing that transition to tech neutral, that the project, whether it's in the under the tech neutral regime or the tech specific regime, it's based on when a project commences construction, which is when you spend at least 5% of the total cost of the project. So if a project is going to fully come online in 2027, but it commences construction before 2025, then it would not yet be under the tech neutral regime. So just worth thinking of that timing consideration as well. And I will just flag here that you have to choose either the investment tax credit or the production tax credit, which we're going to talk about next. You cannot have both. Okay, and then just very quickly, so the investment tax credit that we just talked about is a business tax credit. This residential clean energy credit is the individual taxpayer equivalent. This is a non-refundable credit that covers up to 30% of expenditures. And non-refundability can create issues for monetization, as we've already discussed, but this one has some interesting properties. So for example, residential solar companies often use this one, and the way that they monetize, they sort of make it work, even though it's non-refundable, is the residential solar company will put panels on a homeowner's roof and then lease them to the homeowner. And the developer will get the residential credit and then theoretically will lower the cost of the solar panels to the customer, and it can sort of work well for everybody. So that is an innovation that we see here. No bonus requirements, no bonuses for this individual credit, and no prevailing wage and apprenticeship requirements. And then here we have the production tax credit for generation and storage. So unlike the ITC, which is just that percentage of the fair market value or the cost of a project, the production tax credit is an ongoing 10-year stream of credits that's based on the units of electricity produced. And the stream of credits is priced by the kilowatt per hour if wage and apprenticeship requirements are met. And the electricity has to be sold to an unrelated party, unless it's being used to produce clean hydrogen. That's a little exception. And then like the ITC, it's tech neutral beginning in 2025. Okay, questions about the ITC or the PTC? We can like also hold those for the end, but I'll just like pause here in case anybody's got one.
Yeah, we do have a question in the chat. So it's for the residential tax credit, how does that relate to or overlap with the low income communities bonus, if at all?
So my understanding is it doesn't, because there are not bonuses involved in the residential. Well, in the residential clean energy credit, that it does not account for bonuses. Yeah, okay, but good question. Okay. PTC. So this is just a visual that I think is useful. We're going to talk a little bit more about bonus credits for the ITC and the PTC for the business credits. But it's just worth sort of like looking at this visual and seeing kind of the way that they stack. So you can see that starting from the bottom, wage and apprenticeship forms the base of the stack, and then everything else is a 10 to 20% adder. And so it has the potential, if you can meet all of the requirements, to be, for those bonuses to be quite significant. It's also just worth noticing that the bonuses are richer for the ITC than for the PTC based on how they're calculated. So the ITC credit for the basis, the fair market value of a project, goes from 30% to 40% when you receive a bonus, meaning that the credit amount has increased by 33%, versus the PTC, which is just a straight 10% increase in credit amount per kilowatt hour. So that is a factor that can influence folks to be interested in one or the other. And then some other factors that I'll just run through very quickly: timing and availability of financing. So the ITC gets you the credit sooner because it's, since it's just for the basis of the project, you get it right up front rather than across the 10-year credit stream. And that can be especially important for projects that are cost intensive up front. And then, of course, if you're going to produce a lot of electricity all the time, so for example, if you're developing community solar or if you're developing a solar project and you are in a very sunny area where year round those solar arrays are going to be collecting a lot of sunlight and doing a lot of generation, you might want the PTC over the ITC. Or if you're in a place where it's going to be less consistent across the year, then vice versa. And then project location, particularly certain territories under the proposed regulations are not eligible for the ITC as things currently stand. But again, that's another one to keep an eye on if territorial government's access to clean energy credits is an interest of yours. Okay, let's just chat through some of the other credits quickly. I'm going to spend more time on ones that I think are going to be potentially more relevant, but we'll touch on a number of them, but just maybe faster or slower depending. So clean fuels. So again, we're seeing a move towards tech neutral based on the emissions rates of fuels and the amount of fuel produced. So the IRA extended biodiesel and other alternative fuel credits for 23 and 24, and also created a new sustainable aviation fuel credit. biodiesel and other alternative fuel credits move to tech neutral starting in 2025. And this is another area where how the regulations ultimately explain the calculation of emissions associated with the production of fuel will be significant. So that's something that we're keeping an eye on. And just like with the tech neutral, there's lots of discussion about different ways of accounting for emissions and especially if indirect emissions in the production of certain energy sources. And so that is something that it's worth keeping tabs on. And clean hydrogen, similar conversation. I don't want to spend a ton of time here unless folks have questions, in which case very happy to hear them. Hydrogen is sort of a tricky area. It comes in many colors. The colors of hydrogen are based on the type of energy used to produce the hydrogen. There's two primary forms, something called steam methane reformation, and then something called electrolysis. Electrolysis is a process where electricity is used for the chemical process that produces hydrogen. And electrolyzers can be clean or dirty based on how dirty the electricity that they are run on is. And it's also sort of worth noting that they can use quite a bit of electricity. And so folks are having some thoughts around how to calculate indirect emissions for hydrogen, not only direct emissions. And indirect emissions in particular, when a type of clean energy that usually flows to the grid, if it were to instead flow to a hydrogen producer and be taken off the grid, the energy that replaces it on the grid may not actually be clean energy. And that could ultimately have like a less than positive impact on emissions. Like it could increase the emissions of the grid, even though the hydrogen being produced with that clean energy may in and of itself be green, i.e. be coming from a clean energy electricity source. And so this is again a spot where proposed regulations have been issued and comments are being solicited and final regulations have not yet come out. But as with many areas of the IRA, there's lots of innovation and then lots of questions about how to make sure we're balancing that emissions reduction goal with a desire for these clean energy markets to expand. Okay. And just a few other technologies. This one, I'm betting many of you have heard of. So the consumer electric vehicles and charging infrastructure credits. There's for new consumer EVs, this is a $7,500 up to $7,500 non-refundable credit. But it has a number of requirements for the vehicles to be eligible, the percentage of value of battery components that must be manufactured or assembled in North America, critical minerals used in the battery, the percentage that must be extracted or processed in the US or a country we have a free trade agreement with, final assembly in North America. And so, here we really see that balance between both reducing emissions and also labor and the domestic supply chain. And then for charging infrastructure, and it's also worth saying that to make sure that the EV credit doesn't only have value for high income taxpayers, there's something called dealer transfer that's been introduced. So the purchaser can transfer the credit if the purchaser doesn't have enough, does not, have tax liability, which may mean that they don't have enough income to have liability that they could use the credit against. They can transfer the credit to the dealer at the time of purchase, and the dealer should then reduce the cost of the vehicle. And there are also MSRP and adjusted gross income limitations on claiming the electric vehicle credit, again, to make sure that folks who need the credit are receiving it and that it's not being applied to highly luxury vehicles. And then, the charging infrastructure is as it says here, 30% of cost, assuming wage and apprenticeship requirements are met. And there is a geographic limitation to that as well, that it either must be located in a low-income census tract, the charging infrastructure itself, or in a non-urban area. So this is another spot where we see sort of an emphasis on making sure that historically marginalized groups and low-income communities aren't left behind by some of these tax credits. And then we have a similar sort of a mirror used consumer electric vehicle credit regime, tighter adjusted gross income and price limitations, still leverages dealer transfer. And then there's an interesting one here, commercial electric vehicles. This is it's sort of broader. A commercial vehicle can be a car, but it can also be mobile machinery like a tractor. And it has fewer requirements than the consumer EV credit, including no domestic, that does not have the same domestic content requirements. And it allows leases. So for example, a dealer can lease a car to a consumer and get this commercial electric vehicle credit. So I think that that's an interesting component to the commercial EV credit. And there's emerging technologies. We've flagged earlier, this is 45Q, which is for carbon capture, 45X, which is advanced manufacturing production credit, and then the clean hydrogen credit, as I'd mentioned at the outset. These ones, not only tax exempt organizations, but also for-profits can claim direct pay or elective pay for these credits exclusively, which is interesting. And that's because these are emerging technologies. And I think it aligns with sort of the desire to develop new emerging technology that may be valuable to a clean energy transition. And then there's energy efficiency credits. We'll just run through these really quickly. Lots of really good information about these out there, especially Treasury. The Treasury website has sort of like a place where many of the residential credits are covered, which addresses some of these. But there's 25C, the energy efficient home improvements credit, which provides 30% of, home improvements like windows, new doors, heat pumps, things that improve energy efficiency, et cetera. And then there's new credits for contractors building qualified energy efficient homes, sort of to spur development of efficient of efficient new homes, and then the enhanced efficient commercial buildings deduction, which allows deductions for retrofits and renovations, which is great. Okay, before we do a whirlwind incentives and bonuses on the specific credits, any questions and/or just questions that have popped up on anything that we've covered so far?
Yeah, thanks, Grace. We got a question about the commercial vehicle credit. Would it apply to fleets that are owned by nonprofits, for instance, like buses?
Yeah, I think that that's a great question. And my expectation is yes, definitely it can apply to fleets. I've done less work with EVs personally, so I encourage you to also do a little bit of research here. This is one where there are lots of good resources already available. But my expectation is that yes, nonprofit fleets would be captured here as well.
Awesome, thanks.
Good question.
And then another question about cool roof improvements. Would they be eligible for the energy efficient tax credits or any other rebates?
I don't know for certain. And a big part of lawyering is really admitting when you don't know the answer to something. My expectation is yes, that potentially that could fall into the energy efficient home improvement, but I don't know the ins and outs of those rules well enough to say for certain.
Yeah, thanks. And actually, Cameron, just so you know, we have a partnership with the Smart Surfaces Coalition, which is gung-ho on cool roofs. So we could run that question too through that TA process and see what they think.
Perfect. Yes, that sounds like the right way to handle that one. Thank you, Sandy. Okay. Anything coming up for anybody else here before we just do a quick peek at incentives and bonuses? Okay. So we're going to talk just really quickly about wage and apprenticeship, about domestic content, and about energy communities and low-income communities. The wage and apprenticeship, I'm not going to cover this in a ton of detail, but it basically means that all the people who are working on that folks working on these projects have to be paid a prevailing wage and have to supply, and there has to be a certain number of hours of apprentices, of sort of like that projects have to include a certain number of apprenticeship hours in order to claim the credit. There is a good faith exception for that if a project can't find enough apprentices. So like there is an understanding that that won't always be possible, and there's a process for folks to go through. And then for the ITC and the PTC, the wage and apprenticeship requirements only apply to projects that are larger than 1 megawatt, which for scale is like approximately the size of solar panels on top of an IKEA, would be about 1 megawatt. And so projects that are larger than that have to meet the wage and apprenticeship requirements, but not projects that are smaller. And the feeling is that it will not be probably particularly like it is, there are not so many concerns about projects being able to meet the wage and apprenticeship requirements, but of course, really important for people to know and understand them. But unlike domestic content, where it's going to be a little bit trickier, especially at the outset, for folks to figure out how to meet those requirements, wage and apprenticeship is likely going to be a little bit easier. For the low-income communities bonus credit and the energy communities bonus credit, again, these are both bonus credits that are really focused on the just transition component of the IRA, to ensure that marginalized groups and low-income communities are included in the benefits of clean energy transition, and also that communities that have historically been connected to the fossil fuel industry don't get left behind in the energy transition. And so that's essentially why we have these, and these are really important bonuses. So the low-income communities bonus credit it's an interesting one because it is actually a capped credit, which I know is not something that we've encountered so far because the majority of these credits are not capped. But this is, so it's capped or an allocated credit. So Treasury and the IRS are going to give out credits to an amount of projects. So like projects that total 1.8 gigawatts, which just for context, again, that's enough energy to power San Francisco twice for a year. And so this is really a large amount of energy, but it is capped. And to get the bonus credit, the project has to have an output of the individual project has to have an output of less than 5 megawatts, and it has to be a wind or a solar project, not other technologies and not the PTC. It has to be an ITC, so an investment tax credit. And the project, in order to be eligible for the low-income communities bonus, it has to fall into one of 4 categories. So there's a 10% bonus for projects in a low-income community or projects built on Indian land, and then 20% if it's part of a low-income economic benefit project or if it's part of a low-income housing project. And then the energy communities bonus, this is a 10% bonus for the investment tax credit or the production tax credit for ITCs or PTC projects placed in energy communities. Energy communities are, realistically, they are mainly brownfield sites. They are sites with pollution or contamination that's so significant that it prohibits redevelopment of the property. But the energy communities bonus could also apply to areas that have had historic high fossil fuel employment or significant fossil fuel-based tax revenue, or where a coal mine or a coal-powered plant has recently closed. And so again, this is with an emphasis on ensuring that frontline communities that have borne the brunt of fossil fuel production and of our historical energy production, that they are not left behind in this clean energy transition. Okay, and then we're going to talk very quickly about domestic content. Domestic content is, this is a tricky one. It is focused very much on the US production goal of the IRA, and it's a 10% bonus credit for the ITC or PTC, but it's important to know that for folks who want to claim elective pay, there's going to be a phase out where eventually, after December 1st, 2025, if elective pay projects are not meeting the domestic content requirements, they are actually not going to be able to claim any credit at all. So it's really important for folks to be keeping an ear out for how these rules are unfolding and thinking about how they're going to navigate them, because especially for those elective pay eligible applicable entities, this is one that they will have to eventually be able to meet. And the requirements here are for all steel or iron to be made in the United States and for 40% of the total costs of all manufactured products to be made in the US. And what we're hearing right now is that in practice, this is complicated and it's difficult to calculate because of the sheer volume of manufactured products that facilities use. And it also right now is feeling tricky from an administrative perspective as far as like how to prove, especially that 40% of total costs requirement, what the administration of showing that will look like. And that right now, many taxpayers are not confident that they can meet these requirements, both because of the administrative difficulty and also because of the actual domestic supply. And of course, that's the reason that the domestic content bonus exists, is to incentivize investment in the domestic supply chain. But it is definitely a balance right now. Treasury is beginning to set up processes and is soliciting lots of feedback. And is also sort of contemplating safe harbors for particular categories of items that are not yet available on a domestic level. And so this is, again, an area to really keep your ear to the ground and pay attention to when final regulations come out, and to be, providing comments on domestic content or encouraging folks that you work with who have concerns around domestic content to provide comments to Treasury. Yeah, and I think that once there is more guidance, that will be very helpful, but inevitably this is going to be a tricky one, especially for applicable entities to figure out. Okay, I'm gonna stop here. Oh my God, I made it through all the slides with like 5 minutes to spare. Miraculous. I want to chat just a little bit about the taxpayer services side of this, where to get information, how folks are going to figure out how to do this, especially applicable entities who may never have engaged in filing taxes or claiming credits in the past. But before sort of chatting about that for a minute or two, just want to pause here and see if anybody has questions about what we've just run through.
Well, first off, thank you so much, Grace. This was chock full of information and so interesting. We did have a couple of questions, and I think it might be a good segue into the taxpayer services question. But essentially, it sounds like states are interested in understanding how Treasury is organizing around this. So whether there will be technical assistance, for instance, the example they give is on what counts, for instance, as clean hydrogen. So that there's kind of that education piece. And then is there going to be a point of contact for each state if they have questions about the portal? And it would just be helpful to have sort of contacts at the federal level. So any insight you have on that would be great.
Absolutely. These are great questions. I am thinking a lot about them too. So let's see. I want to start with like some general things to be aware of as far as where to access information. So a few things I would draw your attention to, and actually I can send, I think that all of you are going to be able to find these links very quickly on your own, but Sandy, I can follow up and send a few your way if that's helpful. But there is a landing page now on the IRS's website that is sort of aggregating all of the guidance, all of the notices that they've issued, the proposed regulations as they currently stand, the fact sheets that the IRS has been putting together. They did have recorded some trainings, especially on how to use the pre-filing registration tool. And so I do think that it is really helpful that they've kind of put all of the IRA resources into one landing page. And then that also, I believe, I hope I'm right about this, includes the link to register for the pre-filing registration system once you've listened to the webinar and figured out like what you will need to do in order to finish the registration, et cetera. So I think that is one go-to place. Treasury is working with the Department of Energy, and they also have, I think especially for low-income communities, they've got for the low-income communities bonus, they've got like a help desk set up so that folks can ask questions before they apply for the allocated credit, et cetera. So I would keep an eye on that. Treasury, again, has put together like a really nice interactive website for the residential tax credits, which I know a lot of constituents and states are going to be really interested in. So I think that these are good starting places, especially for folks who are just beginning to get their head around all of these clean energy credits and the changes worked by the IRA. These are like some really good entry points. And then I will also say that there are some great organizations that are doing work focused on reaching especially applicable entities, especially entities that are working with low-income communities, with historically marginalized communities, with tribes, with territories, et cetera. Lawyers for Good Government's FAQ, they have sort of been identified as like a hub for pulling together a lot of the resources that nonprofit organizations are already creating. A lot of their fact sheets and dashboards and webinars, some webinars of ours, I'm pretty sure are on there, and of many other really, really great organizations. And so I would say like they have a mailing list associated with the elective pay FAQ sort of centralized hub. And I think that is a great source of knowledge and place to tap into, especially because it's worth knowing that even for transferability, folks will still have to use the pre-filing registration tool, right? And for small clean energy projects that are operating on a community level, even if they are for profit and they're not, in this applicable entity bucket, they may still have to understand many of the things that applicable entities have to understand, and they might be brand new to many of those concepts also. And so that can be just like a great starting place resource, I think, for many folks. And then you had mentioned hydrogen in particular. And I think that what I would really say is we don't know yet. We don't know yet because the proposed regulations came out 60 days ago. The comment period is actually closing today, although I would say like if any of you have not had the opportunity to provide comments to Treasury and are really interested in hydrogen, or have constituents who are really interested in hydrogen, and you don't make today's deadline, like I think that they usually leave the portal open and like go tell them how you feel about it anyhow. But I think that for hydrogen, you can read the proposed regulations and you can get a sense of how Treasury and the IRS are currently thinking about emissions accounting and how to ensure that the life cycle greenhouse gas emissions of hydrogen facilities is meeting the statutory requirements of being green. But nobody really knows yet. There's been like many different opinions about how that calculation should happen and what those rules should look like. And so like there isn't, I think, a source to go to for the answer, because there is not yet an answer. But what I would do most of all is I would really keep an ear out for the final regulations. And I would also flag organizations that are knowledgeable and have many blog posts and like user-friendly materials. The posts that I tend to look at personally the most often come from the Natural Resource Defense Council. NRDC has done a lot of work thinking about the emissions associated with clean hydrogen production. And they're sort of on one side of concern around the emissions, and I'm not saying that is necessarily my position, et cetera, but I do think that they are breaking down the risks of different types of regulatory regimes in a way that is pretty accessible. So maybe starting there to get some background. Okay, I've gone 1 minute over. I'm going to stay for a little bit, and so if anybody has questions, I'm happy to stay and chat and answer them. But I will stop talking now to release those of you who have to run to other meetings.
Well, thank you so much, Grace. This has been terrific. Thank you all to those who stuck out the whole meeting. This has been really great discussion and great questions. I think just one final question that we have in the chat is any sense of the timeline about when final regulations will be released? I think that's probably the biggest question you get.
Yes, yeah. I wish I could tell you with any certainty, and the truth is, like, I do not know, but I do think that what we're hearing is that there's an expectation that the final regulations for 64, 17, and 18, so for the ITC and PTC for generation and storage, There is an expectation that those may be finalized in the next few months. But I can't say that with certainty. It's just kind of the chatter that I'm hearing. And for the others, for example, for hydrogen and for domestic content, I just don't know, but I will be keeping an ear out.
Well, thank you so much. This has been extremely helpful. And I think because so many state energy offices and economic development organizations are already sort of at the front lines of talking with a lot of people that are interested in the tax incentives, this just gives all of us a really good stepping stone to work from. So again, Grace, thank you so much. Thank you all to the working group members. And of course, if you have any questions, feel free to reach out to me or my colleague, Grace Lowe. We're both on the calendar invite for today. And yes, I too now will release you. So thank you all.